Welcome back to Grow Your Money. Today, we're doing a deep dive into the fundamental analysis of CDSL, one of India's leading depository services companies. If you've ever wondered what goes into evaluating a stock beyond just the price charts, this is the place for you. Now, before we jump in, let's clear something up. This video is purely for educational purposes. We're here to break down the numbers and give you insights, not financial advice or stock recommendations. Remember, investing is personal, and each investor's situation is unique. So be sure to do your own research or consult a financial professional if you need guidance. Alright, so in this video, we'll cover CDSL's core business model, the key financial metrics you need to know, and the factors that can impact its growth. By the end of this, you'll have a better idea of what makes a company like CDSL tick and whether it has strong long-term potential. Sound good? Let's dive right in and see what the numbers say about CDSL. Are you ready? Let's grow your money. Hello, everyone. Today, I'm excited to introduce Central Depository Services India Ltd, or CDSL. Founded in 1997, CDSL is India's second-largest depository, supporting the backbone of our financial markets by securely managing electronic records for millions of investors. Let's take a quick dive into what they do. CDSL operates through three main segments. Depository Services. They handle everything from dematerializing securities to e-voting, making it easier for investors to manage their assets securely and digitally. Data Entry and Storage. This is where they store and manage KYC records for capital market investors, simplifying compliance and data security. Repository. Here, they provide digital storage for policies and warehouse receipts so people can securely access and update important documents online. Each of these segments supports India's move towards a more transparent and tech-driven financial system. To make transactions even more seamless, CDSL offers a range of digital tools like eLocker for safely storing financial documents, MyEasy mobile app for easy access on the go, M-Voting and e-voting, empowering shareholders to vote from anywhere, and Smart, which provides secure access to securities info and transactions. These tools make life easier for investors, adding convenience and security at every step. Leading CDSL is a talented team, including CEO Nihal Vora. He's backed by experts across finance, operations, technology, and compliance. For example, Girish Amasara heads finance as CFO, and Amit Mahajan, the CTO, drives tech innovation. Together, they're working to keep CDSL at the cutting edge of financial services in India. One quick look at employee growth shows how much CDSL has been expanding. From 220 employees in 2020 to 335 in 2024, that's more than a 50% increase. This growth reflects CDSL's expanding operations and rising demand for their digital solutions in a fast-growing financial market. In summary, CDSL is playing a crucial role in transforming India's capital markets. With secure services, innovative tech, and a strong team, they're set to keep leading the charge toward a more digital and efficient financial ecosystem. Now let's take a look at CDSL's compounded sales growth over various timeframes, which shows the company's consistent and accelerating performance. Over the last 10 years, sales have grown at a compound annual growth rate of 25%. For the 5-year and 3-year periods, growth has picked up to 33% annually, indicating strong recent performance. And in the latest TTM, trailing 12 months, sales growth has accelerated to 66%, showing significant momentum. These numbers highlight CDSL's impressive growth trajectory, particularly in recent years, reflecting increased demand for their digital and depository services in India's evolving financial landscape. Let's now look at CDSL's compounded profit growth over time, which reflects their strong financial performance. Over the past 10 years, profits have grown at a compound annual rate of 29%. For the 5-year period, this growth rate is at 30%, and for the 3-year period, it's close at 28%, a steady upward trend. In the most recent TTM trailing 12 months, profit growth has surged to an impressive 66%, showing accelerated profitability in the latest period. These numbers reveal a solid and increasing profit growth trend, particularly in the last year, underscoring CDSL's ability to capitalize on rising demand and operational efficiency. Now let's turn our attention to CDSL's stock price performance, which has shown remarkable growth over recent years. For the 5-year period, the stock price HEGR stands at an impressive 68%. Over the 3-year period, it's grown at 30%, still a very strong rate. And in the most recent 1-year period, we see exceptional growth with the stock price doubling at 100% CGR. These figures highlight strong market confidence in CDSL's business model and growth potential, especially over the last year, where we see an extraordinary surge in value. Now let's examine CDSL's return on equity ROE, which showcases a strong and consistent upward trend over the years. Over the 10-year period, CDSL achieved an ROE of 23%, a solid figure indicating sustained profitability. In the 5-year period, the ROE rose to 26%, reflecting steady improvement. Looking at the 3-year period, ROE climbed further to 29%, highlighting increasing efficiency. And in the most recent year, ROE reached an impressive 31%, marking the highest level in this period. These figures emphasize CDSL's ability to generate shareholder returns effectively with a clear upward trajectory. The significant increase in ROE over time demonstrates growing operational strength and profitability, especially in the last year. Let's dive into CDSL's shareholding pattern over recent years, which reveals some intriguing trends. Starting with the public shareholding, we see a steady upward trajectory. Public ownership has risen from 41.92% in September 2021 to 46.09% by September 2024, reflecting growing confidence and interest from general investors. Meanwhile, the foreign institutional investors, FIIs, tell a different story. Initially holding a substantial 38.01% stake in September 2021, FIIs gradually decreased their holdings, ultimately exiting by June 2022. This complete divestment highlights a shift in foreign institutional sentiment towards CDSL. Domestic institutional investors, DIIs, have also seen some fluctuations. Initially at 20% in September 2021, their holdings fell to 15.25% by December 2023. However, in the most recent quarter, September 2024, DIIs show a slight comeback, climbing to 21.57%, possibly indicating renewed domestic institutional interest. The government's stake has remained unwavering at 20% throughout this period, showing no change in its level of investment. Similarly, promoter shareholding has held steady at 15%, signaling stable commitment from the core founders or primary investors. Overall, the data reflects a notable shift in CDSL's shareholding composition, with public ownership rising steadily and institutional investors, especially foreign ones, reducing their stakes. CDSL's shareholder landscape has seen a clear evolution. This change suggests increasing public confidence in the company's potential and a dynamic shift in institutional investment strategies. Looking at CDSL's institutional investors, we can see some intriguing shifts in confidence and strategy over the past year. Axis Mutual Fund trustee made a notable entry in September 2024 with a 1.03% stake, signaling fresh interest. Similarly, Canara Robeco Mutual Fund gradually increased its holding, rising from 2.15% in March 2024 to 2.13% by September 2024, showing steady confidence in CDSL's potential. Leith II ASM Non-Par has maintained a stable presence, holding a consistent 4.4% in September 2023, March 2024, and June 2024, before a slight bump to 4.42% in September 2024. This reflects a steady commitment to its investment in CDSL. Nippon Life India trustee also demonstrated a gradual increase, starting at 1.97% in September 2023 and reaching 2.01% by September 2024, indicating growing confidence over time. In contrast, Parga Parikh FlexiCap Fund held firm with a steady 4.67% stake throughout the year, showcasing a long-term approach. ICICI Prudential Life Insurance, on the other hand, reduced its holdings from 1.92% in September 2023 to 1.06% by June 2024, before completely exiting by September 2024. This drop suggests a reevaluation of its position in CDSL. Perhaps most striking is Standard Chartered Bank's activity. Entering with a substantial 7.18% stake in December 2023 and maintaining it through March 2024, the bank then exited, hinting at a short-term strategic play rather than a long-term commitment. The variety in investor behavior, ranging from long-term steadiness to strategic exits, underscores a dynamic and evolving investment landscape for CDSL, with different players bringing unique perspectives on its growth potential. Now let's take a quick look at CDSL's promoter shareholding pattern. As we can see, the key promoter, BSE Ltd, has consistently held a 15% stake in CDSL over the past several quarters, from September 2023 through September 2024. This stable holding by BSE Ltd reflects confidence in CDSL's long-term potential and aligns the promoter's interest with the company's growth and performance. All right, if you're enjoying this analysis so far and finding it helpful, go ahead and tap that like button. It helps support our channel and lets us know you want more videos like this. And hey, if you haven't already, make sure to subscribe and hit the bell icon. We've got tons more content coming your way on value investing, market analysis, and stock picks regularly. And don't forget, if you know someone who'd love to dive deeper into stocks, share this video with them. Investing is always more fun when you've got a friend to discuss it with, right? All right, let's go ahead and examine CDSL's market capitalization over recent years. Starting from FY 2020, we've seen a substantial increase in value. In FY 2021, market cap rose to $68,557 million, marking a period of early growth. This was followed by a peak in FY 2022 at $154,697 million. Although it dipped slightly to $94,964 million in FY 2023, the company rebounded with $178,899 million in FY 2024. Currently, CDSL's market cap has reached an impressive $325,622 million. This consistent upward trend reflects strong market confidence and growth potential for CDSL, reinforcing its position as a key player in the financial infrastructure of India. Now let's take a look at CDSL's last close price over recent fiscal years, which shows a strong upward trajectory. Starting with FY 2020, the close price was modest but steadily rose. By FY 2022, it had climbed to 715.8, showing early momentum. There was a dip to 444 in FY 2023, reflecting some market adjustments. However, in FY 2024, it rebounded significantly to 848.115. Currently, the last close price has reached 1558, marking a notable increase and demonstrating strong investor confidence in CDSL. This trend highlights CDSL's growing market value and resilience, with an impressive recovery and growth in recent periods. Let's take a look at the trend in CDSL's price-to-earnings (PE) ratio over recent years, which reflects changing investor sentiment and market expectations. Starting in FY 2020, CDSL had a relatively low PE ratio of 20.06, suggesting modest valuation levels. By FY 2021, we see a notable rise to 32.84, indicating growing market confidence in CDSL's potential. This optimism reached a peak in FY 2022, with the PE ratio climbing to 48.03 as investor expectations for growth soared. However, in FY 2023, the PE ratio adjusted downward to 33.63. This dip could suggest a market correction or a shift in earnings expectations. By FY 2024, the ratio rebounded to 42.3, showing renewed interest and confidence in the stock. Now, looking at the current PE ratio of 61.12, we're seeing the highest level in this period, signaling exceptionally strong market optimism and high growth expectations for CDSL. This upward trajectory over time highlights increasing market confidence in CDSL's ability to drive future earnings growth. Turning to CDSL's EV/EBITDA ratio, we can see how investor sentiment and market valuation of the company have evolved over time. In FY 2020, CDSL's EV/EBITDA ratio stood at a modest 11.68, reflecting a relatively low valuation against its earnings before interest, taxes, depreciation, and amortization. By FY 2021, this ratio more than doubled to 23.61, indicating a sharp increase in market valuation as confidence grew. The upward momentum continued into FY 2022, with the ratio peaking at 35.88. This marked the highest point up to that date, reflecting heightened investor expectations and strong growth sentiment. However, in FY 2023, the EV/EBITDA ratio dropped back to 23.74, suggesting a reassessment of valuation or earnings potential. By FY 2024, it rebounded to 30.67, showing renewed interest. And now in the current period, we see it reaching 43.5, the highest level in recent years. This significant rise in the current EV/EBITDA ratio underscores robust investor confidence in CDSL's future cash flow potential and growth prospects. The overall upward trend highlights an increasing valuation that aligns with optimistic market expectations. Let's dive into CDSL's price-to-book (PB) ratio over the years, which offers insight into how the market values the company relative to its book value. In FY 2020, CDSL's PB ratio was at a relatively low 5, signaling a conservative market valuation. Moving into FY 2021, this ratio rose to 7.45, suggesting increasing investor confidence as the company's value began to climb. The PB ratio reached a peak of 13.61 in FY 2022, reflecting strong market sentiment and heightened valuation. However, in FY 2023, the ratio corrected down to 7.55, indicating a reassessment by the market. By FY 2024, the PB ratio increased again to 11.87, showing renewed interest and valuation appreciation. Now, in the current period, the PB ratio has surged to 21.3, marking the highest level in this period and underscoring strong investor optimism and confidence in CDSL's assets and growth prospects. This upward trend reflects an increasing valuation premium that investors are willing to pay, highlighting market enthusiasm for CDSL's future growth and asset potential. Let's now examine CDSL's price-to-sales PS ratio, which gives insight into how the market values the company relative to its revenue. In FY 2020, the PS ratio was at 7.98. This ratio increased significantly over the years, reaching a peak of 25.88 in FY 2022. It then declined to 15.48 in FY 2023, but rebounded to 19.85 in FY 2024. As of the current period, the PS ratio stands at 28.5, indicating high investor confidence and valuation relative to revenue. The recent increase in the PS ratio suggests that the market is optimistic about CDSL's growth potential, with investors willing to pay a premium for its revenue streams, likely due to the company's strong performance and leadership in the depository services industry. Next, let's look at CDSL's debt-to-equity ratio, which is a measure of the company's financial leverage and risk. As we can see from the chart, CDSL has maintained a debt-equity ratio of 0 consistently from FY 2020 to the current period. This indicates that CDSL operates without any debt, relying solely on its equity to finance its operations. A debt-free balance sheet enhances financial stability and lowers risk, making CDSL a financially sound investment with strong fundamentals. This also allows the company to focus on growth and operational efficiency without the burden of interest payments or debt obligations. Moving on to CDSL's current ratio, which measures the company's ability to cover its short-term liabilities with its short-term assets. In FY 2020, the current ratio was 5.28, indicating a strong liquidity position. This ratio has gradually declined over the years, reaching 2.42 in the current period. A decreasing current ratio suggests that CDSL's liquidity has reduced over time, but a ratio above 2 still indicates a solid ability to meet short-term obligations. This trend might reflect CDSL's efforts to use its assets more efficiently or invest in growth opportunities while still maintaining adequate liquidity. Now, let's take a look at CDSL's price-to-free cash flow (PFCF) ratio over recent years, which sheds light on how the market values the company relative to its free cash flow. In FY 2020, CDSL's PEFCF ratio was modest, reflecting a conservative valuation. By FY 2021, this ratio had increased to 37.39, indicating growing market confidence in CDSL's ability to generate cash. The ratio rose further in FY 2022 to 57.39, showing a continued upward trend as investors became more optimistic. However, in FY 2023, the PFCF ratio skyrocketed to 174.21, likely reflecting heightened expectations or a temporary spike in valuation. By FY 2024, the ratio corrected downwards to 53.87, suggesting a return to more moderate valuation levels. In the current period, the PFCF ratio has rebounded slightly to 70.74, showing renewed investor interest. This trend illustrates the market's fluctuating valuation of CDSL's cash flow generation capabilities, with the recent uptick pointing to a positive outlook from investors on CDSL's future cash flows and financial health. Let's examine CDSL's asset turnover ratio, which shows how efficiently the company uses its assets to generate revenue. Starting in FY 2020, CDSL's asset turnover ratio was at 0.34, reflecting relatively conservative efficiency. In FY 2021, this improved to 0.41, indicating a gradual increase in revenue generation from its asset base. By FY 2022, the ratio rose further to 0.5, marking a significant improvement as CDSL optimized its asset usage. However, FY 2023 saw a slight dip to 0.44, suggesting a temporary decrease in efficiency. In FY 2024, the ratio rebounded to 0.56, and in the current period, it has climbed to 0.62, the highest in this time frame. This steady upward trend highlights CDSL's ongoing focus on maximizing asset utilization, a positive sign for potential growth and operational efficiency. The increase in asset turnover underscores the company's commitment to leveraging its assets effectively, translating into stronger revenue-generating capability. Now let's dive into CDSL's price-to-operating cash flow, POCF, ratio, which gives us insight into how the market values the company's operating cash flow over time. In FY 2020, CDSL's POCF ratio was 27.27, reflecting a modest market valuation relative to its cash flow. This figure increased significantly in FY 2021 to 35.6, showing a stronger market confidence in CDSL's cash generation capabilities. Moving to FY 2022, the ratio spiked to 54.58, marking a peak in this period as investor confidence surged. However, FY 2023 saw a pullback to 38.117, indicating a slight cooling of market sentiment. In FY 2024, the ratio rose again to 46.35, and in the current period it stands at 56.82, even surpassing the FY 2022 high. This rise suggests renewed investor optimism about CDSL's operating cash flow potential. Overall, the upward trend in the POCF ratio highlights a growing market perception of CDSL's cash-generating strength, with the latest figure reflecting strong confidence in its future performance. Now let's take a look at CDSL's payout ratio, a key metric that shows us how much of its earnings the company is distributing as dividends. Starting from FY 2020, the payout ratio was at 47.47%. This means nearly half of CDSL's earnings were returned to shareholders, indicating a solid dividend policy. However, in FY 2021, this ratio dropped to 23.47%, reflecting a more conservative approach, possibly to retain earnings for growth. In FY 2022, the ratio rebounded slightly to 30.22%, but the big change came in FY 2023 when it surged to 56.81%. This spike suggests CDSL prioritized rewarding shareholders with higher dividends during this period. Then in FY 2024, the payout ratio decreased to 39.89%, aligning with a more balanced approach. Currently, the payout ratio has ticked up to 43.14%, signaling a stable and consistent return to shareholders. The fluctuation in CDSL's payout ratio over the years reflects its strategy to balance shareholder rewards with reinvestment for growth, with the current level indicating a commitment to providing a reasonable dividend. Next, let's analyze CDSL's working capital days, which indicates how efficiently the company manages its working capital. Starting from March 2013, we see a negative 160 days. This trend continues to dive, reaching -223 days by March 2014. A negative working capital is generally a good sign, especially for service-oriented businesses like CDSL, as it implies the company is managing its payables and receivables effectively without needing to hold excessive inventory. Moving forward, we notice a shift. By March 2015, working capital days improved slightly to -100 and stayed fairly consistent around this level, fluctuating between -79 and 992 days from 2016 to 2018. This steady trend reflects a balance in managing cash flows, though not as strong as the initial years. Then, by March 2020, CDSL saw a dip to -85 days, followed by a sharper decline to -111 days in March 2021. This significant drop indicates that CDSL optimized its working capital further, likely improving its cash cycle. However, recent years show a reversal of this trend. By March 2022, working capital days increased to minus 75, followed by minus 44 in March 2023, and currently stands at negative 22 days in March 2024. This positive shift suggests that CDSL may be holding on to more receivables or facing slower collections, potentially as a response to changes in its operating environment. Overall, while CDSL has shown effective working capital management, the recent trend toward less negative days could be worth watching to understand if it's a temporary adjustment or a more permanent shift. Let's analyze CDSL's cash conversion cycle, CCC, which reflects the efficiency of the company in managing its cash flows from operations. A shorter cycle indicates a quicker turnover of cash, which is favorable for business operations. In March 2013, the CCC was 34 days. By March 2014, it decreased to 25 days and further dropped to 24 days in March 2015. The CCC increased slightly over the years, reaching 39 days in March 2016 and 33 days in March 2017. It remained in the 30s until March 2020, peaking at 42 days. After that, the CCC improved significantly, reducing to 25 days by March 2021 and maintaining this lower range through March 2023 and March 2024. This trend indicates that CDSL has managed to optimize its cash flow cycle, especially in recent years, maintaining a lower CCC. This improved cash efficiency reflects well on the company's operational management, suggesting that CDSL is effectively minimizing the time required to convert its investments in inventory back into cash. A consistently low CCC makes CDSL more resilient and capable of quickly capitalizing on new opportunities without needing external financing. Let's take a look into Return on Capital Employed (ROCE) for Central Depository Services India Ltd, CDSL, from March 2013 to March 2024. ROCE is a key indicator of how efficiently a company uses its capital to generate profits, and in CDSL's case, the trend tells an interesting story of growth and resilience. Early performance, 2013 to 2019, CDSL started with a modest ROCE of 15% in March 2013, which briefly dipped to 12% in 2014. However, from 2015 onward, we see a steady climb, indicating gradual improvements in capital efficiency. This suggests that CDSL was refining its operations even if the growth was slow and steady. Breakthrough phase 2020 to 2024. The real turning point came in the early 2020s. From 18% in 2019, ROCE surged to 31% by March 2021, then hit 40% by March 2022. A remarkable jump. This likely reflects structural improvements in profitability and operational efficiency, possibly due to increased demand for CDSL services as financial markets grew and digital transactions became more prevalent. The company has sustained this high ROCE level through March 2024, which is impressive. Key takeaway. A consistent ROCE of 40% positions CDSL as a highly efficient player in its industry, signaling to investors that it not only generates strong returns on its capital, but does so reliably. This stability in ROCE is especially valuable in the financial services sector, where fluctuations are common. In summary, CDSL's ROCE journey reflects a company that has evolved from steady growth to exceptional efficiency, making it a compelling investment for those looking at long-term profitability and capital efficiency. Now, let's take a closer look at CDSL's revenue growth over the past few years, measured in crores. Starting in September 2021, CDSL's revenue was around 146 crores. We can see relatively stable performance over the following quarters, with revenue hovering between 137 and 152 crores through June 2022. However, there was a minor dip to 125 crores by December 2022. This period of stability and slight fluctuation could indicate a steady yet controlled growth phase, perhaps impacted by market conditions or seasonal variations in business activity. Moving into 2023, we begin to see signs of acceleration. By March 2023, revenue slightly increased to 150 crores and then surged to 207 crores by September 2023. This marked shift likely reflects either a growth in CDSL's client base, new service offerings, or an increase in activity within the broader market. Entering 2024, the upward trend continued. reaching 241 crores by March and progressing to 257 crores in June. The most recent data for September 2024 shows an impressive leap to 322 crores, a significant jump that signals strong performance and potential expansion of CDSL's market presence. In summary, CDSL's revenue growth trajectory showcases a transition from stable revenues to robust growth in the past 2 years, positioning the company well for continued expansion. This recent surge in revenue could indicate a healthy demand for CDSL's services, a trend that we'll be watching closely in the coming quarters. Profit margin, OPM percent, which gives us insight into the company's profitability and operational efficiency. Starting in September 2021, we see a strong 68% margin, which remains stable through December 2021 and March 2022. However, by June 2022, there's a noticeable dip to 53%. This decline might indicate increased operating costs or a temporary impact on revenue, possibly due to market fluctuations or shifts in the business environment. Over the next few quarters, CDSL recovers slightly, with margins climbing back up to 61% by September 2022, but facing another drop to 55% by March 2023 and a low point of 53% by June 2023. This period shows some volatility, suggesting possible fluctuations in operating expenses or revenue mix. From September 2023 onward, CDSL's OPM percent stabilizes in the 60 to 62% range, reaching 62% again by September 2024. This recent stability in operating margins suggests that CDSL may have implemented effective cost management strategies or benefited from a more stable revenue flow, maintaining a solid margin in recent quarters. In summary, while CDSL's OPM percent has shown some fluctuations, the company appears to have managed its operational efficiency well, especially in recent quarters. The consistency in the 60 to 62% range could be a sign of sustainable profitability as they continue to grow and adapt. Now let's look at CDSL's earnings per share EPS trend, which is a key indicator of profitability on a per-share basis and helps assess the company's growth trajectory. Starting in September 2021, the EPS was at 4.11 rupees, and we saw a slight dip in the following quarters, reaching 2.76 rupees in June 2022. This decline could be due to external factors impacting profitability or adjustments in revenue streams. However, from June 2022 onward, there's a gradual improvement in EPS, reaching 3.85 rupees by September 2022. After another slight dip in early 2023, hitting 3.02 rupees in March 2023, CDSL's EPS begins a more consistent upward trend. From June 2023 to September 2024, we see steady growth in EPS, climbing from 3.52 rupees to a strong 7.75 rupees by the latest quarter. This steady increase over the last year indicates improved profitability, suggesting that CDSL is effectively capitalizing on revenue growth while managing costs. To sum up, despite some fluctuations early on, CDSL's EPS trend shows a clear upward trajectory in recent quarters. This positive trend can be encouraging for shareholders, as it reflects the company's capacity to generate higher earnings per share, indicating strong financial health and growth potential. Moving on to CDSL's reserves, which represent the accumulated profits retained by the company over the years, we observe a strong upward trend that underscores CDSL's ability to generate and retain earnings. Starting from 224 crore, CDSL's reserves have steadily increased, reaching 375 crore and 429 crore over the subsequent periods. This growth continues consistently, crossing the 773 crore mark and further rising to 988 crore. Notably, there's a sharp jump in reserves in recent years. By March 2023, reserves had reached 1,109 crore, and this growth continued, peaking at 1,059 crore before slightly stabilizing at 1,320 crore in the most recent quarter. The significant buildup in reserves reflects CDSL's strong earnings power and prudent reinvestment of profits, which adds to the company's stability and potential for future growth. This consistent accumulation of reserves is a positive signal for shareholders, as it highlights CDSL's financial resilience and capacity for reinvestment. Now let's take a look at CDSL's borrowings over recent years. For a long period, from March 2013 up to March 2022, CDSL maintained zero borrowings, which demonstrates a debt-free approach and highlights the company's ability to fund its operations without relying on external debt. However, there was a minor increase in borrowings in March 2023, reaching 2 crore. This borrowing amount quickly decreased to 1 crore in subsequent periods, where it has remained stable up to the most recent quarter in September 2024. The minimal borrowing reflects CDSL's preference for a low debt or debt-free capital structure, which adds to its financial stability. A low level of debt means less risk for shareholders and shows that CDSL relies on internal cash flow to support growth, making it a financially conservative and stable company. Moving on to CDSL's Capital Work in Progress, SPWIP, we can see an interesting pattern. For a long time, from March 2013 up to around March 2021, the CWIP remained at negligible levels, suggesting limited ongoing capital projects during this period. However, in March 2022, there was a significant spike in CWIP, reaching a peak of 174 crore. This jump indicates that CDSL embarked on substantial capital projects, likely involving infrastructure or technological advancements. By March 2023, the CWIP dropped back to minimal levels and has remained stable through September 2024. This reduction suggests that the major capital projects initiated earlier were completed or significantly advanced, leaving little remaining work in progress. The trend shows that CDSL has made a focused, one-time investment in a large-scale project, possibly to enhance operational capacity or technology infrastructure, without ongoing heavy capital expenditure. All right, folks, that's all about the fundamentals of CDSL. Now, if you've been watching the markets, you know that CDSL is the backbone for many of us retail investors here in India. They've got some really solid numbers, and let me tell you, they're not just coasting along, they're making some strategic moves. First off, their revenue and EPS, earnings per share, are climbing. That tells us they're doing a great job capturing the massive wave of new investors. But here's the kicker. Their operating profit margins are strong. In simple terms, they're not just bringing in money, they're keeping a good chunk of it, which is huge in an industry where controlling costs can make or break you. And then we have their reserves. They're building up cash year after year with hardly any debt on the books. That's rare, right? This means they've got the flexibility to reinvest in growth or tackle challenges without being weighed down by debt payments. Plus, we saw a spike in capital expenditure recently, probably to scale up infrastructure. Looks like they're getting ready to handle even more volume in the years to come. So, here's the big takeaway. CDSL is setting itself up for long-term stability and growth. For investors who want a piece of India's expanding market, CDSL's fundamentals show they're in it for the long haul, not just surviving but thriving, and growing along with India's retail investor boom. All right, folks, that's the scoop on CDSL. Now, I want to hear from you. What do you think? Do you see CDSL as a solid long-term play? Or are you watching something else in the market right now? Drop your thoughts in the comments below. Let's get a conversation going. And hey, if you enjoyed this breakdown, make sure to hit that like button, share this video with others who might find it helpful, and don't forget to subscribe to Grow Your Money for more insights like this. Let's keep building that financial knowledge together. Thank you for tuning in. See you in the next one.